Me into this month's webinar. And this month, we're fortunate to have John Lloyd with us. John's going to talk a little bit about the truth of reverse mortgages. And just to give you some background on John, he's in his 46th year of mortgage lending, having worked as a commercial construction loan administrator at the beginning. And John always talks about his claim to fame. He wrote the checks to pay for the construction cost of the world-famous Inner Harbor project in downtown Baltimore. So if you've ever been to the Inner Harbor in Baltimore, John was a big factor in getting that rolling. John was also a traditional mortgage loan officer and originating branch manager, but for the last 5 years, he specialized in the use of reverse mortgages, FHA home equity conversion mortgages, to assist seniors in meeting their financial needs in the troubling times we've just gone through. He's currently with Security One Lending, one of the top producing organizations dealing exclusively with the home equity mortgage products. He's completed additional training to obtain the titles of Home Equity Retirement Specialist and Purchase Specialist. And personally, he is a native of Harford County, Maryland. He's a U.S. Army veteran, and he's been married to his wife, Marge, for 44 years. So, John, welcome.
Thank you. I appreciate the opportunity of being here.
Absolutely, and I think it's a good topic. You see a lot about reverse mortgages in the media right now. In fact, I'm sure you've seen all the different television ads with Henry Winkler and Fred Thompson and all those guys talk about reverse mortgages. But you see a lot of people make moves based on that. Do you think you can really discuss reverse mortgages in a quick commercial like that?
There is no way that in a 60-second commercial anybody can effectively explain the home equity conversion mortgage, which is the proper name for a reverse mortgage. It's also referred to as the HECM, H-E-C-M, an acronym, and the industry just calls it the HECM product. I usually spend approximately 2 hours face-to-face with my clients during just our first meeting, and then sometimes beyond that, we have second meetings or additional phone conversations before they really comprehend, what are the basics of the HECM program.
Well, what do you consider the basics to be?
Well, there's no short answer. It's not going to be 2 hours, but it's not a short answer. First of all, the HECM is a lien against the property that secures the loan, and the property must be occupied by the owners of the property. And it can be a detached home, a townhouse, a villa. It can be a condominium in any legal configuration that's approved by FHA. All borrowers on title to the property must be a minimum of 62 years old. And then in this transaction, the interest earned on the loan for the dollars that are lent, plus the cost of the FHA mortgage insurance, more on that later, are added to the loan balance monthly. And that means that the balance on this loan, unlike a traditional loan where payments make the balance go down, in this transaction, the mortgage balance actually goes up on a monthly basis. Now, that may seem obvious, but there's an amazing number of people that think this is really free money, and that somewhat goes back to the TV advertising, and that they only have to repay the actual dollars borrowed, and that's not a correct assumption.
Okay.
There are conditions on the loan, as with any mortgage, that can create a default on the loan. Namely that the borrowers must continue to reside in the property as their primary residence. Doesn't mean they have to live there 365 days a year, but it does have to be their primary residence, and we do check on that by sending letters twice a year just to say, hey, are you there? They must pay their own real estate taxes, homeowners insurance, and any community fees. This loan currently does not have any form of an escrow account for the lender to be paying taxes and insurance as is in a traditional mortgage. So that is something that the borrower does have to take care of themselves. They also have to continue to do general maintenance on the property, and the dying is actually a condition of default in this transaction if it happens to be the second party on the loan, because when no borrower is actively living in the property, that's a trigger of the loan being ready for coming to its end. That trigger does not necessarily mean foreclosure, but it could mean foreclosure. Under normal circumstances, it just means that the house is sold, or that through the estate, using some other source of funds, the loan is paid off. Now, the amount of loan that the person is eligible for is a calculation based on the age of the younger borrower and on the interest rate of the particular program they've chosen, and the appraised value of the property. And in today's market, for the minimum entry age of 62, that really works out to about a 50% of appraised value loan opportunity. The next step in the process after I meet with them and have this initial consultation is, before an application can officially be started, all borrowers must participate in what is referred to as third-party counseling. We provide them with a list of approved FHA counseling organizations, and they have to then contact one of those organizations and arrange for either a face-to-face or a by telephone training through that organization that is going to be a repeat of what we spoke about when we had our first meeting. And the whole purpose of that is it is one of three safety nets in this transaction created by FHA to make the transaction as comfortable as possible for the borrowers. Remember, we're dealing with a protected class of borrowers here, age 62 and older, being referred to as senior. A lot of people don't like that title, so we may not use it. Nonetheless, they're in that class, and therefore these rules are established to help them protect themselves from unscrupulous activity and yet still accomplish something that may be very beneficial for them. Until they take that counseling and receive a diploma called a counseling certificate from that organization, no lender can actually start a reverse mortgage application until that counseling certificate is in hand. The second safety feature is that the note on this loan, the debt instrument on this loan, is a very unusual piece of paper. It's called no recourse, and that means that the people signing this loan are more or less acting as a power of attorney for their own home, because they as individuals are not responsible for the payment. If they die or if they sell voluntarily, and it happens that because of how the money has changed hands, how much they've used, how long they've used it for, and what market conditions are 5, 10, 15, 20 years down the road, if this loan is underwater, they have the ability to turn the house over to the lender rather than coming cash out of pocket to make any payment on the loan. And in that situation, the property would be sold and proceeds would be applied against the debt, and then any shortfall would then be paid by the FHA mortgage insurance that I referred to earlier. And it is that FHA insurance that really makes this transaction work, because that's the protection to both the estate, to the borrower, and to the lender, that everybody's going to be made whole in this transaction except for the FHA insurance fund. And the borrower doesn't have to worry about taking cash out of pocket, nor does his estate have to worry about that. The third safety feature is that FHA has created all of the documentation on this loan and all the guidelines. They are written by FHA. They are not written by the independent lenders. And so everybody can be confident that many, many different people have looked at this transaction, drafted proper legal documentation, and are creating a loan that has survivability, even to the point that if the lender that originally made the loan happened to fail monetarily and file bankruptcy or whatever, that would have no impact on the loan. FHA would step in, and either FHA itself would run the loan, or they would appoint another lender to run the loan for the borrower. So the loan, it's protected by the value of the house, but if the value of the house doesn't cover it, then the FHA mortgage insurance takes over. The borrower is still in control of the house. No title has changed hands. If they choose to sell this house because they want to move back with family or just buy another home, they're welcome to do that. They just go through the steps that would normally be taken to notify the lender, make the arrangements to use proceeds of the sale to pay the debt off, and then if there's a shortfall, then the lender would file the claim with FHA.
Okay. And going through that, you explained it really well. I mean, do you kind of see this as, the HECM could be a potential use for every homeowner that's at least 62?
Well, was the Yugo really the car for everybody? I mean, dealing with the audience that we're dealing with, being 62 or older, they all understand that comment. There's a lot of people today that wouldn't understand that comment. But no, there is no one mortgage that is right for everybody. In particular, I can think of one situation where if in the household there are non-property owners living, and normally this would be children, living in the house at the present time under the age of 62, that the owners want to protect and provide for the opportunity of still continuing for those people to live in the house past the death of both owners. That's something that has to be prepared for. Maybe an insurance policy to pay the loan off, because if the borrowers die and it goes to their estate, even though by will the children might be receiving title to the house, the loan still has to be dealt with. And so if no protection has been provided through some alternative economic capacity, be it 401k money or retirement plan money or life insurance money to pay this debt off, then in that situation the children could be impacted by being told that, hey, you got to sell the house to pay the debt. You don't have to come out of pocket for any shortfall, but you do have to use the house to pay the debt if there is no other source.
Okay. And, I think anyone can kind of see how paying off an existing mortgage improves their personal cash flow for a borrower by elimination of the mortgage payment, but how does a HECM actually benefit somebody who borrows?
Well, in a variety of ways, and we've got a slide up here that shows a list of some of the benefits, which would include things like a spousal buyout at the time of a divorce. It's something that can be used for. It can be used to supplement income. It can be used to eliminate some tax burdens created by drawing out of a 401k earlier than anticipated. Taking Social Security earlier than anticipated. There's just a large number of things that can be done. However, we must first take that step of paying off the existing debt. So the loan calculation, going back to that 50% that I used in the initial illustration, we have to first use that money to pay off any existing debt. And then what money is left after that, then that can be dispersed in a number of different funds, including a line of credit or a lump sum payout or setting up some form of monthly payments. But as you can see on this slide, there's a large number of suggested uses, and then creativity can come into play and fill a need. And until I sit discuss with the customer, what is the need? Why did you even ask me to come and speak to you? That's my role, is to say, okay, here's what I can do and here's what I can't do, and what can we creatively put together to solve whatever the issue is that the client has encountered.
Okay. Now, a lot of people might say, isn't this something that a traditional home equity line of credit could do?
Well, yes, it could, but there are some drawbacks to the traditional line of credit. Again, there's a slide here. The traditional line of credit um, works very similarly, but the exceptions are very notable. The HECM line of credit uh, has the safety of not requiring a monthly payment. A traditional home equity line, the minute you use some of the money, the interest clock is running just as it is with ours. But our line of credit doesn't require that that interest be paid. We can add it on to the principal balance on a monthly basis. Where in the traditional line of credit, there's a bill comes out every month and it must be paid. So the more money you use, the more money you're going to be billed for. And then the traditional line of credit, most traditional lines of credit, I'm not speaking to every possibility that's out there, but most of them generally were written with a 10-year term. So 10 years from whenever that transaction started, it's going to expire. And when it expires, a couple of things are going to happen. One, any undrawn money may become frozen and not be any further accessibility. Second is that, and this is the more painful one, the loan is going to go from paying interest only to paying interest plus some portion of the principal over a designated period of time. And in some cases, that timeline matches the original 10-year of usable line of credit. Now you've got a 10-year term of repaying without access to the line for any further draws. And depending on the interest rate and the balance that is due, that can double or triple the monthly burden for making those payments. So our product, not having any limitations on how long you can live, legally there is an age stipulated in the documents that says the loan matures on the 150th birthday of the youngest borrower. We haven't had anybody hit that yet.
Yeah.
But it could, someday it may happen, but it hasn't happened yet. So, if you compare on this chart all of the benefits of the HECM line of credit, you can see that there are some big differences, including one that says that the unused portion of the HECM line of credit actually grows in value at the same calculation as the interest rate being charged on money in use. And we'll talk about that a little later, but it's a very nice feature of the program.
Okay. Well, what other uses are there for the HECM line of credit?
Well, almost anything you can think of. It can be used as part of retirement planning. It can be used to shelter against having to draw Social Security early, and you draw from the line rather than drawing down Social Security at age 62. Wait until full eligibility, or even until age 70, or whatever you want to do. It can be used to offset medical expenses. A variety of things. If we go back to the start of our conversation dealing with television ads, everybody can probably think of an ad that either shows blue dots on a wall or yellow ribbons being pulled out of the center of a circle. All of those are illustrations of the fact that retirement plans, which have been subject to some pretty nasty devaluations over the last couple of years, may not have enough money to last as long as the life of the borrower is going to last. And that's where I see the best use of the line of credit version of this, because that growing feature of the line of credit, even if somebody took it and didn't use it, remember, we only earn interest on the part that we've actually lent. The undrawn money grows, and so that pool of money could be a very useful tool in the future. And opening the line of credit today, even if it's not used, just means there's more available down the road. I have a family that had a known medical need that they think will require in-home care some point down the road. Fortunately, they haven't had to do that yet. The loan's been on the books for about 3 years, and their unused line of credit that started as $185,000 is now worth over $200,000. And as I say, fortunately, they haven't had to draw upon it. So many, many uses of the line of credit that can really be beneficial to the consumer. And it's really a case of matching those features up with individuals like yourself who are tasked with helping people accumulate and grow a retirement plan. But there are market conditions that they didn't plan for, and maybe you couldn't do anything about, that have just had an impact on their needs into the future. And so that's why you and I have created a relationship. I'm a tool for your toolbox, and all we're doing is trying to show your clients that there is a benefit to understanding how to use a screwdriver if it's a screwdriver that you need.
Okay. Any any other ideas or comments on?
Well, the only thing we haven't touched on is that this program can actually be used to also acquire new property. A homeowner that the industry, the real estate industry uses the term right sizing. They don't like to say downsizing, because in some cases people actually buy up rather than buying down. And this is a perfect vehicle for also doing that. And two illustrations shown on the slide that's currently on the screen are the simplest illustrations, because it's really a complicated product, as the whole product is. But a downsizer can take all of the proceeds from their transaction of sale of their present home and put some portion of that down, approximately 50% of whatever it is they're choosing to buy that is a lower priced home, and they can then have a reverse mortgage created to lend them the other 50%, and they get to keep their excess cash in their pocket, in their bank account, or give it to you to have, for you to put it into their retirement plan. Likewise, if they are actually wanting to go upscale, they can put money in equal to the upscale purchase that they want to do. Again, roughly 50% at age 62. And remember, as they age, the loan calculation actually goes up a little bit. It's not leaps and bounds, but they would gain maybe $1,000 of borrowing power each additional year of life. So they put 50% down on this new purchase, and they're able to double their buying power if they really wanted to. If they wanted to put all of the proceeds of the sold house into a transaction, that would be 50% of the value of the new transaction, and they could literally double their purchasing power if that's what they chose to do. So it's really, as I said earlier, it's a very versatile product that I think everybody that has at least 50% of equity in their home should at least take the blinders off and learn what the product might be able to do for them. Whether they choose to do something immediately or choose to do something down the road, that's their choice, but at least make themselves aware of what's possible.
Yeah. That's interesting. I've never really heard it talked about being used a heck for an actual purchase, so I think that's kind of a unique solution right there, without a doubt.
We agree. We think that right now about 10% of all reverse mortgage transactions are being used for purchases. But we think that's a very growing opportunity, just as we believe that that getting financial planning involved in reverse mortgage coordination is another big growth area for the industry, because up until now, most of the TV ads you've seen and the most of the loans that have been done have been what the industry would refer to as rescue transactions, where the only thing we're really able to do is stop the necessity of making a mortgage payment, and there's no money left because that particular group of borrowers just had enough equity for us to be able to do that for them. What you and I have been talking about today is really the more savvy borrower who does have some retirement funds set aside and does have a 401k and may have a pension plan from work and may own a large portion of their house or may be debt free on the house. But this tool can still be very useful to those individuals in order to incorporate it into the overall structure of their financial plan.
Okay. Well, thanks a lot, John. I appreciate the information. I'm sure the listeners do as well. And again, it's John Lloyd, Security One Lending. If anybody would like his information, just contact me. I'll make sure I get you his email and phone number. John, again, thanks a lot. I appreciate it.
I really appreciate the opportunity to speak with you, Kurt.
Okay, well, take care.
You do likewise.